Every day, trillions of dollars flow mechanically through global exchanges. Pension funds, hedge funds, and retirement systems depend on this continuous movement of capital. The exchange-traded fund sits at the center of this flow. By design, the ETF is a passive tool, engineered simply to buy, hold, and track existing securities. This creates a strange contradiction. A product created purely to follow financial markets has acquired enough mass to dictate their behavior. To understand how a passive tracking mechanism began shaping the very prices it was meant to record, we have to examine the historical constraint it was built to overcome. For most of financial history, broad market exposure was expensive and specialized. Investors relied on high-fee active managers to manually select individual stocks and balance complex portfolios. Mutual funds offered an early solution to this cost barrier. By pooling capital from thousands of investors, they could purchase a diverse basket of companies and spread out individual corporate risk. But mutual funds carried a significant structural limitation. They lacked continuous liquidity. Shares could typically be traded only once a day, strictly after the markets had closed for the evening. The exchange-traded fund removed that limitation. It packaged a diverse basket of assets into a single legal vehicle that could be traded continuously on an exchange, exactly like an individual stock. By combining broad diversification with immediate liquidity, the ETF lowered the barrier to entry for the general public. It provided a highly efficient way to participate in capital markets, setting the stage for a massive shift in how wealth is allocated. That shift was driven by the logic of passive investing. Rather than attempting to outperform the market and paying for managers who often fail to do so, investors realized they could simply own the entire market at a fraction of the cost. This logic triggered a mechanical cycle. It begins with a massive influx of capital seeking passive ETFs. The fund gains immense scale, driving down operational costs. Lower costs attract even more capital, creating a continuous, self-reinforcing momentum. Millions of individual decisions to seek lower fees aggregated into a systemic migration. Global wealth moved out of discretionary stock picking and into strict, rules-based mechanical strategies. But this mechanical system presents an immediate logistical challenge. When billions of dollars suddenly flood into an ETF, how does the fund actually acquire the shares of the underlying companies? The answer lies with authorized participants, or APs. These large financial institutions act as the exclusive intermediaries capable of creating and destroying ETF shares. When ETF demand spikes, authorized participants purchase underlying corporate stocks and swap them for newly minted ETF shares. When demand plummets, the process reverses, returning shares for underlying stocks. This constant arbitrage keeps the ETF's price strictly tethered to its holdings. While this plumbing successfully maintains accurate pricing, it also establishes a direct mechanical link. The passive flow of money into an ETF automatically translates into purchase orders for the underlying stocks. This linkage operates blindly. When capital flows into a broad market ETF, it is allocated based on index weighting. A company receives investment dollars based on its market size, regardless of its fundamental health, its current debt levels, or its overall profitability. This creates a mechanical feedback loop. Massive companies receive a larger share of ETF inflows. Those inflows support the company's valuation, which increases its index weight, ensuring it attracts even more blind capital during the next inflow. If trillions of dollars are allocated mechanically, strictly following rules that ignore business fundamentals, who is actually determining what these companies are worth? Markets require price discovery, the analytical labor performed by active investors, who parse cash flows and assess risks to establish accurate market prices. The modern financial system relies on this labor. The massive passive investing machine functions by free-riding on the analytical work of the active investors it is steadily displacing. The stability of this arrangement is tested during a sudden macroeconomic shock. Fear spikes, risk appetite vanishes, and investors scramble to sell their ETF shares for cash. Under severe stress, the structural plumbing can choke. Authorized participants face difficulty transacting in the underlying securities as bid-ask spreads widen and market making becomes increasingly risky. A sharp contrast emerges between Wall Street and the real economy. Corporate stock prices collapse under the selling pressure, even while the targeted company's factories are running, employees are working, and cash flows remain intact. During these liquidity freezes, ETFs often detach from their tether, trading at steep discounts to the calculated value of their underlying assets. In these moments, ETF discounts function as transparency mechanisms. They expose hidden, severe illiquidity in the underlying markets that would otherwise remain difficult to observe in real time. In a crisis, the market price of a business plunges far faster than the operating business itself. The financial markets prioritize and react to liquidity constraints long before they reflect fundamental economic reality. Going forward, the system faces two distinct trajectories. On the upside, ETFs continue to democratize global wealth, relentlessly lowering the costs of investing and expanding market access for ordinary households. The downside trajectory sees passive capital grow so dominant that fundamental analysis withers. The broader market becomes increasingly fragile, highly concentrated, and dictated almost entirely by mechanical flows. Navigating this requires monitoring specific warning indicators, index concentration, shifts in liquidity conditions, and the survival of active price discovery mechanisms. The exchange-traded fund began as a simple convenience, a cost-effective tool designed to offer cheap diversification. Over decades of growth, it evolved into the primary mechanism dictating global capital allocation. The evolution of the ETF proves that markets function as integrated mechanical systems, structures that are ultimately reshaped by the tools built to navigate them.